Hey everyone, I am really excited to have you here this week, but before we dive into anything, for all of you guys that are new here watching for the first time or returning, a refresher is always great. Who am I? My name is Kyler Johnson, and for the past about 7 years, I have spent hundreds and thousands of hours learning about the stock market, investing strategies, and pulling lessons from some of the best investors of all time, like Warren Buffett and Ray Dalio. With everything that I've learned, my focus is on finding great companies trading below their intrinsic value, or fantastic companies, as you've maybe seen me talk about here before, trading around or just below their fair value as well. And my goal with the strategy is really just to create excess returns from the market without having to take on large risk. Over the past 7 years, learning and growing and trying all these strategies, I have certainly made mistakes along the way. And hopefully with all of those, I've been able to incorporate how to better invest, getting excess returns while not taking on a lot of risk. And risk blowing up your account, as really you want the long-term compounding to work in your favor. So that's really my goal here with this channel. And you guys can know that everything that I talk about here is what I'm actually doing with my own money. I would be doing this research with or without you guys here. So you can always know I am quite literally putting my money where my mouth is every single time. So with that, let's jump into what the actual plan is here today. We're going to be talking about the Fed rate decision and the slowing balance sheet runoff. Next, going into the China consumer sentiment and the Hang Seng index there and just kind of what's going on. A few portfolio updates with some of my holdings with Boeing, Dow, Comstock, and Cooper Standard. Both Dow and Comstock reported earnings this week, so we'll be talking a little bit about those. And then we're going to finish off with a full analysis on a new company, GXO Logistics, ticker symbol GXO. So with that, guys, hope you guys stick around for this week's market spotlight ending 5/4/24. Excited to have you guys here. So first off, this Wednesday, obviously some of the biggest news in the market. Anytime that Fed Jerome Powell, he speaks, the market definitely listens. And as expected, they did hold rates steady at 5.25 to 5.5%. But more important than that was honestly their slowing pace at which their balance sheet is shrinking. So in the past, they have essentially been allowing the bonds that the Federal Reserve has purchased from the government to fall off their balance sheet without being replaced. And they're going to be slowing the rate at which things are falling off, meaning they're buying more back to replace. Still, some will be falling off, but here is a article, Central Bank to Slow Balance Sheet Reduction in June by Nicholas Yahinsky. And in here, they talk about since 2022, the Fed has been allowing up to 60 billion in treasuries and up to 35 billion in mortgage-backed securities to mature monthly without reinvesting the proceeds. Essentially, that's just falling off and they're not doing anything with it. But starting June 1st, the Fed will lower the monthly treasury runoff to 25 billion, meaning that there's going to be an additional 35 billion that they're going to have to replace each month that's going to be coming in as demand to the treasury market. And this was by far the bigger news for me this week. And it means that as demand increases, the supply isn't really going up, as the government essentially said that they're not going to be increasing their issuances going forward, but supply is coming up. The Fed is going to be a buyer, and I think that that is going to push rates down. It's going to be bullish for treasuries. And on that day, on Wednesday, the 10-year rates fell 0.092 percentage points, which was a pretty big deal. And because of the Fed announcing this, they were actually originally, I believe, supposed to announce it down to a $30 billion is what they were going to let run off. They actually decided to do even more and are letting only 25 billion fall off. And because of this and in anticipation of this, because Jerome Powell had announced this a few weeks ago that they were going to be doing this soon, I had added some call options on TLT to my portfolio, and I expect to get about 2 to 3 times my investment there. They're not a huge percentage of my portfolio, just some money, some cash that I had sitting aside that I could put to work to really go long into the end of the year. They've already done very well, but we're going to let them keep going over the next few months and be able to capture some capital to go long into the end of the year, which I'm really excited about. On another note here, it is very hard to know what inflation is going to come in the next few months. There's so many variables and things. I hope you guys know that trying to predict things like this is incredibly complicated. And so it's hard to know exactly when rate cuts are going to be coming in, although the Fed definitely signaled that there are a few different avenues in which they would end up cutting rates this year. So I think there's still definitely some on the table, but it's kind of interesting to think about how the Fed policy currently being restrictive, and if they leave it restrictive for too long, it could seriously weigh on U.S. growth, and I don't think that they want to push it into that by any means. So my portfolio doesn't necessarily count on any rate cuts happening anytime soon. Certainly, I think it would be beneficial to the portfolio, but it does not rely on that by any means. Purchasing companies that are fantastic below their intrinsic value. So if rates stay the same forever, fine by me. If they go down, great. Either way, we're going to be making money is the goal. So another thing that happened this Friday was the payrolls report, and they came in pretty much as Goldilocks as you could ever hope for a report to come in as, with 175,000 jobs added this week, which was far below the over 200,000 expected, and dropped significantly from around the 300,000 last week, which was like I said, pretty much as Goldilocks as it gets, especially since on Wednesday, Powell said if they saw a weakness in the jobs report, then it could again lead to a scenario where they might want to cut rates, as their dual mandate is to not only keep inflation in check, but also promote maximum employment. And if they see the jobs market kind of showing some weakness, then that could be another reason that they would start cutting. And this was just kind of another catalyst for bonds to get a bid, which was really exciting. I wasn't necessarily counting on that, but it was really, really great to see. And along with that, you guys can see this is just the 10-year yield going down a total of about 0.2% from its high this week, which is pretty awesome. And I was able to capture the entirety of that move. Still, I think we've got quite a bit this can go, but it was great to see. Also, with all of this, this is the US dollar index, and you can see this most recent week was down, the US dollar weakening, and I think this trend will probably continue. The dollar, as rates are raised, generally strengthens against other currencies. And so now, as we're looking and have much more focus on rate cuts coming, the dollar is going to be weakening there. There's tons of other factors. That's a crazy oversimplification, but kind of one of the main trends that it follows. So I certainly expect the US dollar to weaken over the coming years here, which is great news for China and other emerging markets as their currencies strengthen against the dollar and they're able to do more. So some great news there. Moving on now to China and the consumer sentiment. I was curious in looking into this and found something very, very interesting. As you guys can see here, the consumer sentiment going all the way from 1990 until now, it is absolutely far below every other place it has been in this history. And I actually really, really like this. When you've got situations like this where it's so low from where it has been previously, people can get incredibly depressed about the markets. And if you guys have followed the Hang Seng at all, that's probably pretty dang obvious from where the stock chart sits right now. and it has been crushed for the past several years. And so now, sitting as low as it is right now, we've really only got one way to go, and that is up from here. Now, take that with a grain of salt. It certainly could go lower. There could be bad things happen. But whenever you've got a market that is depressed as it is right now, it means multiples are so low, and it can be an incredible buying opportunity. When everyone hates something, usually there are no sellers left, and that's a fantastic time to step in if you do your work and understand what, in this case, a country has in its future. And China still has, in their population pyramid, they've got a good chunk of people coming up to the prime spending ages between 35, 45, around there. They've still got a good chunk of their population coming through that was bigger than previously. After this, it's going to get a little dicey, but I really like China for the next 5 or so years, and it's a big part of my play. This is great to see, and I wanted to show you guys what things have kind of looked like over the past, really since 2018 or so. The Hang Seng has been nothing but down, and it's just this little blip that you see here has been an absolute rip higher. Even though on this chart it looks basically like nothing, we're still down over 40% from highs. So we've still got a long ways to go here, but there's a lot of promising signs coming in. Bids coming back into the Hang Seng that I am very excited about and positioned to capitalize on. Now let's go to some portfolio updates. Just some quick things on these different companies. First off, with Boeing, I X'd this, tweeted this, whatever the proper term is now. This quote by Warren Buffett, and he says, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business." And this is Buffett's testimony to Congress in 2011. Now, Boeing is an absolutely phenomenal company in that it operates as a duopoly. Currently, right now, it is being run terribly. So don't get me wrong when I say Boeing is a great company. They're a great company because of their moat, not because of how they're currently operated, although I think they're going to be turning that around. They've only got one real competitor in Airbus, and if people go to Airbus continually, it's going to be 2 decades out at some point when they get their plane, and people are going to say, that doesn't work for me, I'm going to Boeing, because that's their only other option. So when you operate in a duopoly like that, it puts you in an incredibly strong position. People have to come to you. It just works like that, and that's the way it's going to be. I'm very excited for this company, and they've been bouncing a tiny bit off their lows. We still got a long ways to go, and this will probably be several years before we really see a perfect turnaround for the company as they get a new CEO at the end of this year, and we'll see what they're able to do. Now moving on to Docal, that announced earnings this week. Really came in pretty much as expected. Their whole, my whole strategy here with this company is just around polysilicon prices and riding the waves as prices improve here. You guys can see their average selling price since the highs starting in 2021, 2022, and dropping off in 2023 are still extremely low and probably will stay low, honestly, for many quarters here. I don't expect to turn around anytime soon. And just because of this, their sales and things are down, but this is still a very well-run company. They've got incredibly low production costs. They're one of the lowest cost producers in the world. And that's one of the reasons why I like them. They also have an incredibly strong balance sheet. And wanted to share a quote from their earnings that I found very interesting and was some very exciting news. So this is what they said. The solar industry has gone through multiple cycles in the past, and based on our previous experience, we believe that the current low prices and market downturn will eventually result in a healthier market, as poor profitability and losses, as well as cash burn, will lead to many market players exiting the business with some possible bankruptcies. Later in the earnings call, there was this dialogue with a question from an analyst who said, "What's your guess as to what percentage of the industry could shut down by the end of the year?" And the CFO said, "This is very ballpark. I think about half would shut down." That's some serious news there. Now, take it with a bit of grain of salt for sure, because the company is always wanting to project really rosy futures. So we'll see what actually happens. But even on the table that some of the supply could fall off of the market just towards the end of the year, if you think demand right now is still increasing, supply is increasing incredibly fast, which is why prices have fallen to where they are now. But if supply stops growing and demand starts to outpace it, prices are going to start to rise, which is what happened in the past. And if you guys watch my full analysis on DoCal, you'll see has happened many times in the past and is the exact cycle that I'm going to be looking to take advantage of here. So it was great to hear that on their earnings call. Really excited for this play. The next one that we're going to be going over is Comstock Resources, a natural gas company. They reported earnings on May 2nd. And as expected, they were hurt by low natural gas prices, but they had a fantastic focus, I thought, on their call and in their reports of operating as efficiently as possible while prices are low, cutting costs where they could, shutting down rigs and things like that that aren't necessarily going to be the best move for the company right now while gas prices are so low. And as one of already the lowest cost gas providers, they're poised fantastically to fill demand in the future. They talked quite a bit on that call as well about filling demand for future data centers for AI. And I couldn't agree more there. So in this article below from Yahoo Finance, they talk actually exactly about that demand coming in from AI. And they say the rapid ascent of AI usage is a boon to natural gas consumption, and its impact should be seen already this summer. Now, because there's so much supply on the market, it's probably not going to make a huge difference for the time being, but very similarly to DoCal, as companies run unprofitably for a long time, they eventually exit the market or demand starts to really pick up. And we could honestly see a little bit of a combination of both here, which will be really, really interesting. They also said in this, "We believe no other commodity can match its return potential this year in respect to natural gas," which is on the top of their list. It's really exciting. Another article that I was able to pull up, which they had some quotes from Google's chairman in 2023 regarding LLMs. And this is what he said with in regards to interacting with an LLM and searching on there. He said, "It will likely cost 10 times more than a standard keyword search. As a standard Google search reportedly uses 0.3 watt-hours of electricity, this suggests an electrical consumption of approximately 3 watt-hours per LLM interaction." Meaning as AI potentially ramps up and people start using that, whether it's through Google or Bing or whoever else is going to launch an LLM, doesn't really matter. It is far more energy intensive than a regular Google search, meaning the US has got to come up with a way to fill that demand and quickly. And natural gas is a fantastic way to do so. They could be a great beneficiary of this play as demand rises. We'll see what kind of happens there, but just another little cherry on top for this company that I'm very, very excited for in the future. Last news on the portfolio, Cooper Standard, and just some news about auto sales first. In the U.S. first quarter, auto sales grew 5.1% despite higher interest rates. There are more cars being sold, and this is fantastic for Cooper Standard, which is the main supplier of several different parts to some of the top car manufacturers in the country. Cooper Standard also announced, they said they're pleased to announce and be recognized as General Motors 2023 Supplier of the Year. And it was just awesome to hear, investing in a high quality company like that and for their turnaround play. really excited to hear the good news in both of these here, auto sales growing and General Motors recognizing them as one of the best suppliers they have. So with that, guys, we're now going to jump into the full analysis of GXO. Very excited to get into this with you guys today, and hopefully you find this valuable. This is a company that I was introduced to by Thomas Hayes. I really owe looking into this at all to him, and definitely check out his channel. I will link it below, as I do oftentimes. Always enjoy listening and get a lot from there. You guys will probably see a lot of what I get is from his channel, and points me in the right direction. He's got a lot of resources, so definitely check him out. GXO Logistics. Obviously, they are a logistics service company, and we're going to talk about what made me interested in actually adding this to my portfolio. They're currently just a small position, but let's get in. You can see their stock chart here, IPOing in 2021. Really, they're down quite a bit from their all-time high, 105, sitting currently around $50 a share, down about 50% from their all-time high. And starting with companies that are down, this far from their all-time high is a great place to start. Obviously, you got to do more work there, but it is a great place to start looking at companies. So let's get into what this company actually looks like. The current CEO of GXO is Malcolm Wilson, who was previously the CEO of XPO Logistics, which spun off a couple of their businesses, one of which is GXO here. And he was previously the managing director of XPO Logistics as well. And between those two roles, he worked with XPO from October 2007 until August 2021. And below is the stock chart of this XPO during that entire time. And I hope you guys can see how monster the gain of this stock was during that time, ending up being a 28 bagger in that period, which is freaking awesome to see. And so really the biggest way that they were able to achieve this growth was through acquisitions. They made a ton of profitable acquisitions that grew their market share, grew their revenue, their profitability, and they were able to really capitalize on their management in logistics to be able to take over these companies and improve them, run them more profitably, as well as expand their reach in the logistics market as well. And below are some of the best and the more notable acquisitions that XPO Logistics did while Malcolm Wilson was there as either managing director or CEO. 3PD in August 2013, Pacer International in March 2014, Norbert in April 2015, and Conway in October 2015. Really, my play on this company is betting on the horse here, Malcolm Wilson, the CEO, who has a fantastic experience running logistics companies and purchasing others that he can then turn around and run more efficiently to drive growth. And I expect the exact same here, and that's proven to be exactly what they are doing. Another note from 2007 to 2021 for XPO, the cash from operations grew from $4 million to a peak of over $1 billion, but grew to about $800 million in this time to 2021, which is crazy how much growth they were able to accomplish in these 14 years. Crazy, 200 times the original cash from operations. Probably not 200 times their current cash from operations at GXO, but this is a longer term play, one that's going to be compounding for quite a while. I'm very excited to be a part of this one. Below are some highlights from their most recent full year 2023 earnings call as well. A couple highlights. Their operating return on invested capital was 36% in fiscal year 2023. This is absolutely phenomenal. When you see a company that has this type of return on their capital, invested capital, you know that they are well run. You know that the management knows exactly what they're doing and where their capital can be allocated most effectively. And when you've got a company like this that you know can allocate capital effectively, you can be willing to and able to pay more for them and still get absolutely phenomenal returns, which is what I would say I did here. This is companies probably trading around fair value, in my opinion, maybe a little bit below, a little bit of a discount, but they are run so well and their management has such fantastic experience that even though you're paying fair value now, if their revenues are growing in, high single to low double digits, and they're so efficient that their return on invested capital is above 30%, this is a phenomenally run company. And they have had a 26% year-over-year growth in free cash flow. Again, just kind of highlighting they're focused on efficiency and, as we'll talk about later, automation as well to drive margin growth, not only for them, but to provide higher quality services to all of their clients. Some of their biggest wins in 2023 and extensions with clients, you guys might know a few of these. You've got Nike, you've got Heineken, you've got PepsiCo, you've got Unilever, you've got Red Bull, LVMH. You guys might know these other companies better than I do, but there's some big names, guys, and they are winning extensions with them, and they are not just a single year extension. On some of them, they are decade or longer. I think their average, they said, was around 6 years extension. So these guys are capturing market, and they are proving to these companies that they are where they want to be because they get things done, and they do so efficiently. And it's a value driver for these companies as well when they're able to outsource their logistics, take that off their plate, and hand it to a company like GXO that knows what they are doing and knows how to get it done better than the company would themselves. That's why these companies are doing it. And their contract wins, as you guys can see, 32% of their wins came from competitors, 29% was just new activity, and almost 40% was outsourcing, meaning these companies previously had just done this in-house. They had managed all of their supply chains and logistics in-house globally and decided that GXO offered enough value that they wanted to actually hire that out completely. And to me, this says a ton about GXO's value proposition to these other companies, that they are able to take something off their plate and charge them for it, and it's worth it for these companies. So they have got a ton of growth potential here. I think they said on their call as well, there was 300 billion of addressable market of companies that have this in-house, their logistics in-house, not to mention the other, hundreds of billions of already other logistics that is run by competitors. But there's a ton of opportunity here, and they are showing they know exactly what they're doing, which is pretty awesome. On their call as well, regarding the contract wins from sites previously operated in-house, the CEO, Malcolm Wilson, said, "The pace of supply chain outsourcing is accelerating. More companies are seeing that companies like GXO can take that off their plate and run things more efficiently, and they're starting to turn their work towards them, which is exciting to see." They also mentioned throughout the call many times that they're continuing to work on increasing efficiency and automation of their processes using robots and AI to deliver a better product and service at a lower cost to their clients. They, on this call and others previously, just are hyper focused on operating efficiently, allocating capital correctly, and they're just obsessive about it from everything that I can tell on these calls, and I absolutely love that in a company. Another thing, they recently acquired Wincanton, another logistics company that's headquartered in the UK, and GXO CEO recently said on that acquisition, "By combining Wincanton's footprint and proven expertise in the UK and Ireland with our global reach in transformative technology, we can provide a wider range of services to new and existing customers across geographies and accelerate our long-term growth trajectory." This is what this company does with acquisitions. They can grow more quickly than if they were to just rely on taking market share, taking from competitors, bringing things in-house. They can also purchase existing companies, and they did so phenomenally with XPO and are doing the exact same with GXO Logistics here. And it's really exciting to see, guys. Excited for this company. They're going to be announcing earnings here in next week, I believe. I believe it's on the 7th, if I remember correctly. And I will be paying close attention there. Just excited to hear all the good news. Even if it's bad, that would be actually even better in my opinion, because then I can buy more of this company at a fantastic price. So either way, I'm very excited. My assumptions here really just rely a lot about around Malcolm Wilson and the other leadership of the company being able to run things efficiently. So as long as they're able to perform profitable acquisitions to grow GXO, and they run GXO as profitably and efficiently as XPO, that's pretty much my assumptions here, guys. The logistics market is not going away anytime soon. Things are in fact getting more and more global as companies are looking to increase their reach into all the countries across the world. This is only going to get more and more important, and as they're currently one of the leading companies implementing technology and automation, they're really at the forefront, and I am so excited for the future of this company here. Excited that I was able to find them and add them to my portfolio for the long-term growth that they have, and can't wait to hear on the earnings call the progress and things that they've made, how much business that they were able to win from competitors, from companies doing it in-house. So we will see that coming up. But hopefully today, guys, this was really valuable for you. Not only talking about what's going on with the Fed, what's going on in bonds and interest rates, a few different updates on China, as well as different companies that I've covered previously in the portfolio, and a full analysis on GXO. Let me know, guys, down below any questions or thoughts that you had. I'll do my best to get to every single one of you with helpful and informative information if you have any questions. Always remember, guys, as well, this is just my opinion. It's not advice. I don't know your financial position. I'm not a financial advisor. This is work that I'm doing for myself and investing for myself, which obviously I know my own situation here. So with that, guys, excited to have you here, and we will see you in the next one.